Hi, I'm Pattu from freefincal. Let's take a look at the NFO from UTI AMC, the UTI Nifty200 Momentum 30 Index Fund. This is a open-ended index fund that's going to track the momentum index from the NSE. That is 30 stocks with momentum picked from the Nifty 200. I think this is a special index that was designed because of an arrangement with UTI, because the index was launched very close to the filing of the NFO offer to SEBI. So a lot of people are excited about this momentum index fund. They think they're going to get something extra. Let's find out. So momentum investing is basically choosing stocks that have done well over the past 6 to 12 months and hoping that the trend would continue. I have talked about momentum investing in a couple of videos. I think one was a talk I gave, and I talked about how this the past trend tends to continue in future, not for all stocks, but at least for some. I've also shown how it works for the Indian markets, the US markets, and so on. The Nifty 200 Momentum 30 Index will pick 30 stocks with the highest momentum score from the Nifty 200. The Nifty 200 is 50 stocks of Nifty plus 50 stocks of Nifty Next 50 plus 100 stocks, 100 mid-cap stocks from the Nifty Mid-Cap 150. So they're going to define a momentum score, and this is a combination of 6-month momentum and 12-month momentum. So 6-month momentum is going to be defined as 6-month return divided by the standard deviation over 6-month, daily return, standard deviation of daily returns. 12-month is 12-month return divided by 12-month standard deviation, and then they're going to find the average of the 6-month momentum, average of 12-month momentum, find out the stocks that are well above average, and then choose them. I've talked about this again in a separate video about how they are picked, etc. and so on. So I'm not going to get into how the index itself is constructed. You can check my previous video on that. So because of this interest, they want to try and hope for about 1,000 crores NFO AUM. 1,000 crores for an index fund in NFO is very good. UTI has already pulled it off with their Nifty Next 50 earlier, but most of that NFO AUM will be regular AUM and not a direct plan. Alright, so what are the pros and cons of this index fund? The pros is quite obvious. If you are doing momentum investing on your own, if you have a DIY momentum portfolio, then you will have to bear the tax associated with the change in stocks, because the stocks will change often. And if you, instead of that, if you were to invest in this fund, then the tax associated with the churn will not be there for you. Similarly, if you were to invest in a basket of stocks via your broker, for example, like small case, then again this tax incidence will be there, and that can be avoided by choosing the index fund instead of those arrangements. Now this the momentum index will have a 5% gap on individual stock. But it can have concentration weight, that is, it can be overweight on a particular sector. Also, the rebalancing is done every 6 months. Some people may argue that it's too late. You will have to do a little more, you have to rebalance a little more quickly, but that's how the index is constructed, and you will have to live with that construction risk. Now, the primary risk is, of course, will the fund be able to beat the Nifty or the Nifty Next 50 for a given period of time? And I will show you that it has not done that for certain times, particularly after the crash. When the market recovers after a crash, the momentum index has not been able to capture the momentum of the market well enough, and when the market is range bound, then again it has failed to beat the market, so to speak. And also, the problem with momentum is that if a stock has got high momentum, then it can lose that momentum as quickly as it gained it. So the volatility will be definitely higher, and that always is going to be a problem. And I have already talked about the S&P 500 Momentum Index, and I showed that the S&P 500 Momentum Index does not beat the S&P 500 often enough. It is not consistent outperformer. It doesn't beat it often enough. And in fact, if I look at the last 10-year data out of the last 10-year window, in that window, the first 6.8 years, the momentum index did not beat the S&P 500. Only in the last couple of years it has bet, and that kind of a frustrating experience can be seen in the NSE momentum as well. So you'll have to be careful about this. Also, the Nifty momentum index will be having an expense ratio of at least about 0.5%. So this is 5 times more expensive than a Nifty index, which is 0.1% or so, and that's always going to be a problem. And that a higher expense means that outperformance margin will be lower. Then you will have 30 stocks from the top 200, which means that there will be mid-cap stocks as well as Nifty Next 50 stocks, which are also in a way mid-cap. So tracking errors could be higher with this fund. What I would suggest is that if you are investing in Nifty and Nifty Next 50, you don't need any additional fund. Already you are a momentum investor. There is no need for you to include this Momentum 30 index, because the way the Nifty and the Nifty Next 50 is constructed, you already are participating in the market momentum. And if you are a DIY momentum investor, then you can compare your performance with this momentum index and consider switching to this fund. If you are invested in some kind of small case momentum or something like that, then again you can compare your performance with this index and benchmark it, and then consider shifting. At the very least, you will be paying lower tax, and that could probably enhance your returns that much more. So now let's talk about the actual performance. And I've added Nifty Next 50 because it's intrinsically a volatile index. So let's compare the volatilities of the momentum index and the Nifty Next 50. Now, if I look at the since inception evolution, that is from 1st April 2005, most people will only look at this and they'll get misled by this, saying, oh, what an amazing performance by this momentum index, I'm going to invest and so on. Don't do that mistake. If your advisor is not capable of analyzing a product beyond this, then you should immediately get rid of such advisors. So let's dig deeper and find out. What we will do is to find out the relative index moment. That is, we will take the momentum index and divide it by the Nifty 50. And that's the pink line in this graph. And that's the pink line is with respect to the left axis. And the momentum index and the Nifty 50 are with respect to the are with respect to the right axis. Excuse me. So if you look at this pink line, that's the ratio of the two indices. If this ratio increases, that means that the momentum index is moving up faster than the Nifty 50, or it has fallen less than the Nifty 50. If this ratio falls down, then it means that the momentum index is not moving as much as Nifty 50, or it falls more than the Nifty 50. And you can see something very interesting if you zoom this up. This is the behavior from 1st January 2017. Notice that this is from late 2017 onwards, there was a market inhomogeneity, and the Nifty was driven by just a few stocks. I talked about this several times before. And notice that once that market inhomogeneity started setting in, particularly it was obvious from budget day 2018 onwards, and you can see that the momentum index starts falling down. The momentum decreases significantly, and only when the crash occurred, I had said that the imbalance was destroyed, and when the imbalance was destroyed, then the momentum index shot up during the market crash. But after the market crash, when the Nifty started zooming up, the momentum index did not capture that momentum as much, and the ratio started falling down again. So if you actually see the data from March 23rd, 2020, the momentum index has failed to beat both the Nifty Next 50 and the Nifty 50. So this momentum has not been captured. The momentum over the last few months have not been captured by the momentum index adequately. Again, if you notice this behavior between 1st February 2018, you can see you can see the momentum has not been able to beat the Nifty 50. So you are going to get these kind of frustrating periods, and you're going to pay more expense ratio for this, which is unnecessary. And you can see how the recovery from after the 2008 crash and recovery, the Nifty Next 50 recovered a lot more faster, but you can see the momentum index has just been keeping pace with the Nifty 50. So it actually continued from July 2008 to about another couple of years more, up to 2012 or so. You can see this kind of underperformance. So that kind of 4 or 5 years underperformance you have to be ready to face, and I don't think it's necessary. The UTI AMC says the index will select outperforming stocks and reject underperforming stocks. If it had done that properly, then it should be able to beat the Nifty at all times. That clearly is not the case. So you'll have to be very, very careful. See, the entire outperformance that you saw in the first graph came from January 2012 to January 2018. This is the only period where the maximum outperformance came. This is the only period where the momentum index worked. Outside of this period, on either the left side or the right side, it failed to work. So it's very important to appreciate these things about the momentum index. This is the drawdown, that is the fall from a maximum, and you can see that the during the 2008 crash, that the momentum index, the red line, has fallen more than the Nifty, and it also did not recover quickly. You can see, that's what I just told you. The momentum should have captured, the momentum index should have ideally captured the market momentum and recovered faster than the market itself, but it did not do that, both in the 2020 crash and as well as in the 2008 crash. This is the comparison of drawdowns with Nifty Next 50, and both the red line, the momentum index, and the green line, the Nifty Next 50, are more or less comparable, and that's quite interesting. Also, in terms of the rolling standard deviation, which is the standard deviation of daily returns, the Nifty Next 50 and the momentum index are fairly comparable with respect to each other. Now you have the rolling returns, and you can see out of 2,700 rolling returns, for quite a bit of time, when the market was range bound, the momentum index failed to beat both the Nifty and the Nifty Next 50, and only later it has been able to outperform over 5 years. I have the data over 7 years and 8, 10 years and so on, but the point is that the number of data points reduced by more than half. So we have very little history to gauge the so-called outperformance of the momentum index, and this is something that investors should be really wary of. So it's not a bed of roses where it's going to come regularly beat the market. You have to be ready for long periods of underperformance. If you are already an active mutual fund investor, please don't buy this, because you are only going to clutter your portfolio. If you are already if you are already holding Nifty Next 50 and Nifty 50, Nifty Next 50 is anyway going to underperform for several years, as it has done. Why do you want to add one more fund which behaves like that? Some people may say, I am investing only in the Nifty, can I buy this? Well, if you want to buy an expensive replacement for Nifty Next 50, go ahead, but have small exposure, otherwise it can be dangerous. So my suggestion is, don't get enticed by all this momentum strategy, etc. Please evaluate it properly and understand what is happening. Now, I have been talking about low volatility stock picking. You may ask me, is that also not a gimmick? It is not a gimmick, because when you buy low volatility stocks, you are guaranteed of low volatility. Even if you get market returns, you are going to get market returns at lower volatility, at 25-30% lower volatility than the market. So that's a guaranteed benefit. Momentum is not a guaranteed benefit. Please stay away.